Good morning, Richard Calhoun, Creekside Realty, 40 years working here in Silicon Valley with buyers and sellers with their real estate needs. Here's my contact information. We'll dive right into it. We're talking about week number 35. This is showing the two components in the real estate market, supply and demand. You might wonder why there's three lines. I have two different measures of supply. The total available inventory is the blue line. My definition of total available inventory is listings that are on the MLS available for the consumer without a contract with another buyer. Now, if we're having a perfectly normal year, it would be right on the yellow line, which is the 5-year median 2015 through 2019. We were at 80% last week. We dropped down to about 70% this week. This drop down is mostly because of the timing of the Labor Day holiday. Just like the gray line is the new listings for the week, it shot up way higher than normal compared to the 5 years, and that's because Labor Day is as late as it can be. Basically, it's on the 6th. It could be on the 7th. So the holiday impact was less, so more sellers came on the market last week. Now we're having the impact of Labor Day, so that's why it came way down. Those two are the supply side. Then you flip over to the red rust-colored line, and that's the demand side. And the number of offers went skyrocketing, and that's because there was an influx of extra listings last week, the week before. So now last week we had extra offers to make up for, to basically use up that extra inventory that came on last week in week 34. And again, now if you look at the demand, it's 60% above the 5-year median, but that's because normally we're comparing it to a week that would have included Labor Day. So next week, I expect this number to come way down for two reasons. One, the holidays impact it, and the fact that there's basically been no new listings this week. There's going to be no listings for buyers to buy during the next week. So that's overall. Now, what's important is the days of unsold inventory. That's the supply-demand ratio. That's what in a free economy dictates future pricing. So you can see that anything under 40 days I consider to be a red-hot seller's marketplace. Anything above 80 days is a ice-cold buyer's marketplace. Between the two is a balanced marketplace. It's sort of weird that Silicon Valley spends very little time in a balanced marketplace. It's usually only in a balanced marketplace when it's transitioning from a seller's market to a buyer's market or vice versa. You can see that normally we start off the year slow, and that's because of the holidays. But then once we're past the holidays, it rapidly ramps up, and ramps up means a faster paced marketplace. So it's lower down on the curve. It's one of the few graphs where the lower the number is, the hotter the marketplace is. And so then you can see somewhere normally around week 16, all of a sudden the inventory, the days of unsold inventory starts slowly increasing. Not rapidly, but that's basically just the normal cycle we're in. And this year you can see it's basically stayed flat. Yes, there's a big perturbation here, but what was that? That was July 4th. So right now we're coming up on Labor Day and we're right back to where we were. Now, again, the median yellow line is going to have Labor Day included. The blue line is not going to have Labor Day included. So I'd expect the blue line to go up next week, even if the market stays unchanged. So understanding the impact of holidays on the marketplace helps, because if you were to see a line shift like this, you'd say, wow, the market's really changed. And I think that's what we're going to see next week, is this blue line going way back up, just like we did on July the 4th. We went from 20 days of unsold inventory to almost 40 days in 1 week. I mean, that should send off a red flag in everybody's mind if you weren't aware of the fact of the impact of the holidays. This slide actually caught me by a little bit by surprise. I maintained that the market started off down around here, improved gradually all year, then turned around and actually started slowing down probably in the month of May and June. And then in the last couple of weeks, we turned around and saw an improvement. This is clearly, the purple line is the current week and is probably the worst week up there. You might argue that the gold line down here is worse, but up here the gold line is quite a bit better. And then I said, why would this be happening when all the indications are the market has been picking up? The first thing you have to remember is this is sale price, so it's delayed by the length of escrow, 5-6 weeks, plus the number of weeks that you get offers over, which is another 5 weeks. So it's not in sync with something like days of unsold inventory. So that's the first thing. But I think what's going on here is the old hangover where people that tend to be financially strapped try to close at the end of the month because it keeps their upfront costs down by reducing the amount of prepaid interest. Now, they're not saving any money after they've been in the house for a couple months, but it reduces the amount of cash up front. I've sort of thought that that became a less significant as interest rates go down because the amount of prepaid interest goes down. But that's about the only explanation that I have, is that buyers that were financially tight closed this past week since it was the last week of the month. And if they're financially tight, you're going to overbid less. And it was basically the high end that got impacted, because if you come down here, you can see it's buried in the middle of the pack. And so if the number of people not bidding above 10% went down, you'd get exactly this line. Now, I have not looked at this data in this kind of detail in the past, but I think that's the best theory I can come up with. To support the fact that the market's improving is the yellow lines back over here, or highlights, are basically the peak appreciation over the calendar year 2020. What I'm pointing out now is we have some areas that are basically above the previous record, not by a whole lot, 110.9% versus 9.8, 27.9 versus 26.9, and a tie 23.6 versus 23.6. Having not broken a record for several weeks, and now all of a sudden have three that are breaking or tying a record, is significant. You also have areas that are close, 24 versus 25, 20.8 versus 22. Again, that's an indication that the market's improved from the doldrums back here around the middle of August. And that's a quick recap for the week. I'll pause as I go over these URLs. The green here is what I call my root URL. To come to the meeting live, you just add the 2021 at the end of the year. To get to the archive of this specific or any specific presentation, you add in the year, month, day code. And to get to the handout, which is posted, you add the word handout and the date that you're trying to get. So I'll pause and see if anyone's got any questions for me. Seeing no questions. So now we're looking at the breakdown. This is what I consider the key indicators. Days of unsold inventory, DUI, is number one. It's the supply-demand ratio. It's the indicator that has the least lag time on it. So you sort of understand where the market's going from it. The overbidding gives you the flip side. It sort of says how much pressure the buyers are feeling, but you have to wait that extra 5-6 weeks to get that data to get the sold price. So what we're looking at now is we're comparing, now is this week, and maybe I should call it this week. So we have this week versus last week. So you can see single family homes in Santa Clara County improved from 22 to 18.8. You know, why? We had a lot of extra inventory 2 weeks ago. And so last week we bought up a lot of that inventory. So that increased the number of sales in the last week, and that reduces your DUI. Sort of the same thing happened in San Mateo County. Condos and townhouses are sort of almost flat. It's actually interesting in San Mateo County. My benchmark there is just the condos and townhouses on the Bay cities, because it's by far the bulk of the market. And if you bring in any of the other areas, you sort of dilute what's really happening. It actually slowed down. So that was sort of an interesting observation. The frequency of overbidding, this is how common is overbidding, is basically unchanged and unbelievably high. I mean, 83% for single family homes and 72% say for condos and townhouses. That's pretty significant. The magnitude of overbidding. San Mateo County is outdoing Santa Clara County this week. They're at basically 110% in San Mateo. Santa Clara's not far behind, about 108, 109%. The condos and townhouses are lagging, but still 104%. You know, if you do a market analysis, determine what you think the property is worth, and get 4% more than you're asking, that's pretty good. Now, more than you're asking may not be more than the property is worth, because some people intentionally price the property on the low side to attract multiple buyers, assuming that's how they get the maximum price. And to a large degree, I agree with that, as long as you don't price it so low that buyers are saying, well, I'm not going to go 10% 10% over. I'm only going to go 7% over. Once you start getting that resistance, you priced it too low. Now what we're looking at is the active inventory in the different components. And we're looking at the current week. And maybe I should try to get consistent and call, instead of calling it now and current, just call it this week. So this week, we only had 387 single family homes in San Mateo County. We only had 675 in Santa Clara. The previous week, and I should call that last, was 794 and 411. What I found interesting was Santa Clara County dropped 15% in 1 week, where every other type of property was pretty stable. And even Santa Clara condos dropped 11%. So, you look at San Mateo County, and yeah, there was a little bit of a drop in single family homes, 6%. There was almost no drop in their townhouses. But you look at Santa Clara County, and it was a huge drop. It doesn't surprise me that the drop is more significant in single family homes than in condos and townhouses. It does surprise me the difference between the counties. And I haven't really looked at this before, but it was enough that it caught my interest. So I added in this percentage drops to catch people's attention. I expect with the holiday being over that we'll see a flood. In fact, I would almost predict that Santa Clara County will see a bigger flood of new inventory than San Mateo County. Time will tell, but that's my best guess. Offers in the past 1 week were 240. The past 5 weeks were 1262. If you multiply the 1 week by the 5, you almost get right on the money for Santa Clara. Some of these other numbers, you're lagging behind. You're only at 400. So that means that it really slowed down in the single families in San Mateo County. And you can see that because you went from 26 days of unsold inventory up to 34. Again, that would normally sound every alarm bell I have, but with the holidays, it's simply a holiday impact. Santa Clara County was amazingly unchanged by it. And I think the reason for that was the large influx of new listings the week before, 2 weeks back at this point. Condos and townhouses, they're much more stable. They just tend to roll around. So 39 days of unsold inventory versus 36, 28 versus 25, not the dramatic change that you saw in San Mateo County. This is looking at the 3 components over time, and look at the drop off in DUI in the single family. Santa Clara County is just boom, right off. And that's basically what happened this past week. There's I do a data point every day, even though we only meet weekly. And so there's probably about 7 or 8 data points here where it's just plummeting. San Mateo County went down pretty good. Condos and townhouses in Santa Clara County were pretty flat. I also spent some time and cleaned up some of the data points that were bad. I still got 1 bad point here that I should be able to get. And these 2 back here are old enough that I'm not sure it's worth my time, but I've been trying to clean up the data to make it a little more presentable as I go. This is looking at heat map, days of unsold inventory, single big, most important indicator, showing you the redder the color, the hotter the marketplace is, the lower the days of unsold inventory. For those that are observant, I used to think that 10 was the saturated red, and I got on my computer today because we had one here in Foster City at 9.1, and it wasn't saturated red. So I wanted to go scratch and find out why. And it looks like I've actually programmed it for 7 to be saturated red. I'm going to go back and relook at that because that was a quick glance, not what I had thought I had done. So that always makes me a little nervous. I thought it was at 10, and that there's a lot of reasons why 10 makes sense, but 7 makes sense too. It's 1 week. There's been times when Cupertino's gotten down to 5 days. So I'll go back and get a specific answer, but right now I'm sticking with 7. But that it just changes the gradients ever so slightly. But basically, the redder the colors, the hotter the marketplace, the faster the marketplace. The only area that's in a balanced marketplace at all is the expensive areas in San Mateo County. You can see that they're at 75 days, and at 77 and a half, it's in a stark shading blue, but we're not there yet. This is looking at total inventory over time. You can see that we're starting to really lag behind, and this is the whole macro market. So I'm taking both single family homes and condos and townhouses. So we're only at 1,500. We should be at 2,250. So you're 750 short. You're 1/3 of your anticipated marketplace is missing, 750. So that's pretty significant. You can see last year we were right on the marketplace for a long time. And then we actually had surplus inventory. And we even had surplus inventory at the beginning part of this year. Now, the media and most consumers won't don't agree with that, but that's what the data shows. Then we had normal data, and it was only until week 16 that we had below. Now, while we had normal data, I will acknowledge that Santa Clara County single family homes had a shortage compared to the normal, but macro data, which we're talking about at the moment, was absolutely non-normal. This is the number of new listings coming on the market. And when you look at this, it's hard to pick up any anomalies at all on here. Basically the number of new listings coming on the marketplace is exactly where you would expect it to be. So this concept of sellers fleeing Santa Clara County, it's not happening. If they were fleeing, it would be more new listings coming on the marketplace. If Prop 19 was to encourage sellers to get out of their home that has a lot of equity and move, it would be showing up as more new listings each week. It's not happening. Now, frankly, from a financial point of view, sellers should get up and move once they have more than $250,000 per person equity. And the reason for that is once you hit that level, you're only receiving about 55% of the future appreciation, when Uncle Sam and state of California taking the other 45% in taxes of capital gains. Now, if you hold it until you die, yes, you get a free step up in basis. But if you need to go in a rest home and are forced to sell or become a conservatee and the conservator sells the home like they always do, a huge chunk of your estate is going to disappear. Whereas if you simply buy your neighbor's home, you can transfer your property tax once you're over 55 and you start getting that future, 100% of that future appreciation. So when we're talking about numbers of appreciation of like 20% and you're giving up almost half of it, you've given up 10% with homes worth about $1.6 million single family in Santa Clara County. 10% is $160,000. That's a lot of money to get up and move, even if you bought your neighbor's same floor plan next door and traded houses with them. But anyway, it's not happening. And I think that's not happening is the real story versus my sidetrack. Number of new offers, you can see the number of new offers every single week is above where you expect it to be. With number of new offers above where you expect it to be and new inventory just where you expect it to be, there's a shortage in the markets faster than you expect. And that's exactly what we've been experiencing. Now, let me go back for just a second and look at the magnitude of the vertical spacing. That's what's important. You can see we had some vertical spacing here, but it was pretty reasonable. Now the vertical spacing is getting pretty significant. You're talking in this period of time here, 100 homes. So we're selling 500 homes instead of 400. That's an extra 25% of inventory. So we're selling a lot of extra stuff. And that's something I haven't quite figured out. If you have the same number of homes coming on the market every week, and yet we're selling 25% more, at some point we go down to zero. And to some degree, we're already limited, which is why when we have a extra inventory coming on like we did last week, this week we had a lot of extra offers to make up for that inventory. So that does show you are supply strapped, but at some point it's going to become real apparent and the level of inventory is going to get even lower. But I got a little surprise coming up later too, so maybe I shouldn't have spoiled it, but we'll get there. Number of closings, I really don't see anything very valuable in this line. You can see how there's a huge spike that probably corresponds with the end of the months. And the reason it doesn't happen so much on the 5-year median is it moves around a little bit more when you're taking in 5 years of data. So this is spiking a little bit more and a little more frequently. I would have expected a 5-week cycle, and but it's 4 or 5 week, which is sort of what you'd expect, and also a cycle with a holiday. But the closing data is simply the offer data delayed by the length of escrow. This is overbidding. You can see we're fairly stable. I went back and cleaned up some data points, but there is still more sawtooth than I would expect. And at this point, I didn't get this far back, but that sawtooth level is really there in the data. So I am keeping track of my work going forward. Some of the sawtooth did disappear with me making errors of different kinds, including a few typo errors, which I try to minimize. But anyway, that is cleaned up a little bit for you. This is looking at the overbidding over time. If you look at San Mateo County single family, it's just been climbing here since about June 12th or something like that. Not really rapidly, but pretty significantly. Santa Clara County sort of did a hilltop and then a little bit of valley and came up to a plateau potentially. It's just interesting. But, when you're seeing all three types of properties or all three major micro markets, it's above 70% and single family above 80% of overbids. That's huge. There's no way to say anything about that. So this is the frequency of overbidding on the heat map. You can see the redder the color, the higher the number. So our highest overbidding right now is at Foster City at almost 96%. So it's saturated red, because I do believe it's at 95%. It goes saturated red. The lowest is the expensive areas in San Mateo County, but still more than half the sellers are getting more than their asking price. I mean, you go anywhere else in the country and say that you had this kind of overbidding, and I think they'd call you crazy, but that's what we have. This is the magnitude of overbidding. This is the average of every transaction for the past week in both types of property in both counties. And so it includes those that are getting less than asking price. If I included only those over, the number would go up some, but not a whole lot, just because there's only 10% probably that are getting below. About 5% are getting asked, 10% below, and 85% above. So it doesn't change that much. But we're coming down a little bit at the heat of the marketplace. We're up here about 108.5%. And we're down now at about 107%. Not huge, but a little bit of cooling of the marketplace. Here's the heat map showing you the areas. Probably one of the things that I've commented on before is South County is actually magnitude wise is very little. And by very little, it's 6%. That's still pretty significant, but their frequency of overbidding is much higher than the magnitude would indicate. And so it seems that people are moving down there potentially for more affordable housing. So they're more concerned about their pricing. It's also an area that had not been used to the degree of overbidding. So agents and consumers just aren't used to overbidding. So they might be a little bit more hesitant. This I added, I think, last week for the first time. It just shows you the three components on one graph. So now you can pick your favorite micro market area and look across and get real numbers and real color code. And I am going to look into how easy is it to add in the condos. And that way everybody would get all 22 micro market areas. So that's something that I'm planning on working on. I think it's a nice little chart, and I will keep it unless people tell me it's redundant. We've looked at this chart. I'm bringing it up just again because now we're looking at the most recent 12 weeks. And here you can sort of see the purple really lagging on the top end. But you start coming down here to 50% of the buyers. And yeah, it's sort of on the bottom end, but it's buried enough in there that it's sort of hard to see. But overall it's on the lower end, but up here is where it really dropped off. But when 15% of your sellers are still getting more than 15% above their asking price, how bad of a marketplace do we have? And the probably the biggest problem we have is we don't have enough inventory to satisfy the demand. This now is looking at the sale price. I'm looking at three numbers. I'm looking at the 10 percentile, the 50 percentile, which is the median, which most people follow, and the 90 percentile. The coloring is assigned based on the median price. And the nice part about it is between the left-hand number, which is the cheapest, and the right-hand number, the most expensive, 80% of the homes in that range are in between those two numbers. So in South County, 80% of the homes are between $800,000 and $1.8 million. And it's just worth knowing. And then half of them are in this first numbers, this 400,000 here. So in 400,000, you have 40%, and here in 600,000, you have 40%. And the split is roughly 1/3, 2/3, just if so anyone's interested. And this is a surprise. It's a little hard to read, and I don't know how much this is my screen versus I'm just trying to scrub in too much data, cram in too much data. But I do like to have 20 years worth of data on there. And why this is a surprise is I'm brought up August data. Now, August data is not complete because it has to get today's data in there. So it's not going to be complete until about Tuesday of this week because you needed a couple days for people to report. But I'm used some knowledge to try to get pretty good estimates. I'm actually going to challenge myself and leave these up next week and do a comparison. But this is where I think the numbers will come in. And so what you can do is you can look at 46 days average on the marketplace. And basically that's the lowest we've ever been. Median is 17 of what's on the marketplace, the lowest of what we've ever been. Inventory sticks out. If this holds true, and it probably will, 660 listings. That's getting down to the level that we typically have at Christmas time, 560. The lowest we ever had at this time of the year was 723. So we're almost 10% below where we were in 2017, which was a fantastic year. And what was unique about that year is we had a second round of appreciation that basically was happening right now. And I'm not so sure we're not having it and people just aren't aware of it yet. Offers accepted 17 days and 9 days. That's beating 2017. It's beating every other year as well, because 2017 was sort of the fastest previous year. DUI of only 19, it beats 22.4. So this year is stronger than 2017. So the only reasonable explanation, at least that I can have, is you'd expect prices to go back up to cut off the demand. Sales per day, 34.9, stronger than we've had. Now, granted, we've had stronger. In fact, that's tied for 2012, and it actually every year before that was higher than that, except for 2007. I think there might be another one back in about 2003 that's also lower. But basically, what's been very interesting is offers accepted has been declining basically for the last I know for about the last 25 years and probably the last 30 years. So even though the Valley has more homes for sale and more people, we're selling fewer homes all the time. But this is a nice rally. It's not an all-time record, even for this time of the year, but it's a recent history record. This is the actual number, 1222. Median size of home, just to give you some perspective. The overbidding, it's outperforming where we were in 2017, both in frequency and in magnitude. Sale price, we're going back up. We're now again above 1.6 million. And again, price typically goes up, although we do have down cycles. And with that, I am completely finished my presentation. I will bring up the end slide if I can advance it and have people ask any questions. So does anyone have any questions? Not seeing any questions, I will call it a day and see everybody next week. Take care.
Okay, thanks.
You're welcome.